Hello, my name is Stathy White, Chairman of Thomas White International and spokeswoman for our investment team. I'm going to describe our firm's optimistic outlook for 2018 and how our portfolios are structured to benefit from this attractive environment. We feel that the global economy will continue to strengthen in 2018. As in 2017, investors should overcome their fears of terrorism and political disruption, which will likely lift non-U.S. equity markets to double-digit returns. Stimulative programs are still in place in Continental Europe and Japan, the largest regions in our portfolio. These central bankers want to be very sure their current recoveries continue. The next market decline may occur when labor shortages cause prices to rise. The resulting inflation will likely cause central bankers to raise interest rates, which will slow growth and disappoint equity investors. The United States led the global recovery and now has labor shortages. The Federal Reserve has been raising rates to control future inflation. Surprisingly, labor shortages have not yet caused wage increases, so inflation remains low and U.S. equity markets have not yet declined. This lack of wage pressure supports our view that non-U.S. bull markets may last well into 2019. Emerging market investors should enjoy another strong year. Many fast-growing EM companies are financing their growth by issuing bonds to yield-starved investors in Europe and the United States. This year, Chinese policymakers are focused on improving their bank lending standards and spending aggressively to reduce pollution. While this will likely slow down expansion in emerging markets, the growth rate in the developing countries should still be 2 to 3% greater than their developed counterparts. Our stock selection continues to emphasize companies that run capital-lean businesses, have tight cost controls, and exercise disciplined capital spending. We believe these firms are better placed to outperform their industry peers in the moderate growth environment that exists today. We are still emphasizing cyclical as opposed to defensive non-cyclical companies. We also like banks as they benefit from rising interest rates. Shortages in skilled workers have caused us to increase our exposure to firms that produce labor-saving robots and factory automation equipment. At Thomas White, we feel our portfolios are well positioned to benefit from this improving global growth outlook. Thank you.